The next battle in asset management is underway, and the prize is the contents of your wallet, or maybe your retirement fund. Buyout barons and private credit funds have grown big by hawking their products to big custodians of cash, think university endowments, sovereign wealth funds, and pension schemes. Now these alternative asset managers, firms like Apollo Global Management, Blackstone, and KKR, are coming after millions of smaller investors. Most private investors have some publicly traded stocks and bonds, plus some cash, maybe a bit of gold or crypto for the more adventurous. But ordinary savers generally have almost no direct exposure to private capital, and that is changing. The Trump administration last month declared it would, in the words of the White House, democratize access to alternative assets, clearing the way for even ordinary investors to put some of their hard-earned money into private equity, real estate, commodities, and so on. The sums are potentially vast. Blackstone President John Gray talks about tapping a, quote, wealth space worth $80 trillion. Yet this push raises all kinds of questions. Can asset managers structure funds that are suitable for large numbers of smaller investors? What happens when those clients want to cash in? And what are the asset managers going to do with all the money? So this week on The Big View, we're going to talk about what private capital's retail push means. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights into the biggest stories in finance, business, and economics. I'm your host, Peter Thalassen. In a moment, we'll hear from this week's guest, Lawrence Calcano. Lawrence is the chairman and CEO of iCapital, a marketplace connecting private investors with private assets. But before we do that, I'd like to welcome Jonathan Guilford, Breaking View's US editor and our resident guru on alternative assets. Hi, Jonathan.
Hey, Peter. How's it going?
So, Jonathan, this push by alternative asset managers into the retail market is getting a lot of attention at the moment, but it's been underway for some time, hasn't it?
Yeah, I mean, if you look at the firms that kind of set the tone for what we now call, alternative asset managers, really, it's all these buyout barons that ended up moving into private credit and real estate and so on, right? Blackstone sort of blazed the trail here. There have always been various ways in which the ultra wealthy could get some access to private equity. Maybe you pull a bunch of individuals together and they can take down a stake in a traditional fund. But what Blackstone did that was really kind of novel at the time was they created these big vehicles that just they have no set end date. It's not like a traditional private equity fund where, you put money in at the beginning, you wait for 5 to 7 years, and then the money comes out. These are just gigantic kind of dollar harvesting machines. And they have a bunch of kind of oddball features. You can come in at any time. You can cash out to a limited degree at any time. And they kind of have focused on some of these occasionally, it's not really like the core verticals that we think of with these guys. It's not like private equity. It really started off with real estate. So BREIT was Blackstone's big vehicle, and it kind of moved on from there.
So yeah, that's interesting. I guess that also raises, for me, one of the big questions about all of this, Jonathan, which is, as you say, the traditional model is you pool together a load of money from deep-pocketed investors, you lock it up for 5, 7, maybe even 10 years. And then at the end, you sort of, and then as those investments mature, you pay it back to them, and then and then you can turn around and do it again. But if you're letting private investors take money out when they need it, then isn't there there's a sort of fundamental disconnect there, isn't there? Because the underlying assets, most of them, are still pretty illiquid.
Right. This is the thing, and this has been the big tension in the market thus far, which is a lot of these big vehicles. I think what you tend to hear from folks is, we market them as semi-liquid, emphasis on the semi, but the customers hear the emphasis on the liquid. So you take BREIT as the example, right? You can buy in, in any of these kind of monthly purchase periods, and then you can redeem your cash back out of it, but there are limits. So there's a monthly limit and there's a quarterly limit on the percentage of the net asset value that can be redeemed at any time. And so when we had the kind of big like interest rate cycle shift as we came out of the post-COVID boom, people were getting maybe a little bit nervous about what was happening in real estate. BREIT was the big story of that era because it ended up hitting against those limits and withdrawals were limited for a long, long time. Now, obviously, you speak to folks in the industry and they will say, look, this is the product working as intended. This is preventing a fire sale of assets. But I think it was like a first kind of proof point or test that like maybe there are limits around this kind of traditional, well, I call it traditional, all of like the last 5 years. But this kind of model that was the big initial push into retail, there are limits around that. And now we're talking about pushing further into like a whole bunch of new kinds of structures.
Okay, so we're gonna talk to Lawrence about this. Just tell me, just briefly, what made you think he would be a good person to address this topic?
Yeah, so I mean, iCapital is sort of this underlying technology that really enabled what we think of as this current era of the retail push. It's one of these brands that has become so ubiquitous. You kind of associate certain companies with certain really big kind of like market shifts or eras in certain industries. I think iCapital is one of those ubiquitous names that you kind of hear all the time if you're covering alternative asset management. So they're this sort of technology layer that sits underneath everything, and it connects the alternative asset managers like Blackstone or Apollo or whoever with the wealth advisors. So some guy sitting at, Morgan Stanley or some independent registered investment advisor who is turning around and trying to put some of these private funds into their customers' portfolios. So iCapital is sort of like the glue that holds everything together. And you hear people talk about it as kind of an operating system or what have you for the way the industry works right now. So Lawrence and the team there have really, really deep insight into what has actually been happening as this retail push has moved on.
And obviously, he has a background in investment banking at Goldman Sachs and so forth. So he's also a kind of a good sort of financially literate person to talk about this. Okay, thanks so much, Jonathan. Let's hear what he has to say.
Lawrence Calcano, welcome to The Big View.
Nice to be here. Thanks very much for having me.
No, thank you for joining us. So for those of us who care a lot about private equity, credit, and so on, iCapital kind of feels like one of those brands like Kleenex or Sellotape at this point, like it's so ubiquitous. But for all the people who maybe aren't like closely scrutinizing the back end of what the Blackstones and Apollos and whatnot of the world are doing, do you maybe want to just kind of introduce iCapital to our listeners?
Sure. Thanks so much. So we're really trying to enable this whole journey. And when I say this journey, I mean, for all of the different constituents, right? So you have financial advisors who are trying to, get educated in many respects, get educated on alternatives, get access to great alternatives, be able to provide all of that education and access to their clients. They want to have a good experience, an automated experience where they can see things and buy things in an automated fashion, where they can own things, where automation helps make the experience good, both for them and for their clients. And on the other hand, the GPs who very much want to access this highly fragmented wealth market and do so with some scale, just in the same way that they can raise money institutionally in a scaled way. They'd like to also access this marketplace in a scaled fashion. And we try to provide the infrastructure and the plumbing to allow both of those, sort of groups of folks to have a great experience learning about or marketing alternatives. In addition, given the breadth of the ecosystem, there are other really important players as well, such as custodians or administrators or transfer agents that play important roles in how these products are either brought to market or managed. And so we're building a technology platform. We've built a technology platform to help manage all the different things that the different constituents sort of do as part of owning these assets. And I point out, and this, these are long-lived assets, right? These are not short-term investments. And therefore, the technology piece of this is so critical in terms of creating that, sort of multi-year experience that is a good one for all the players involved.
Right. Yeah. I think like kind of the common way I hear it referred to is like you guys are like the operating system piece effectively on the back end there. Because like for folks who maybe aren't as up to speed on kind of, I guess, how much this market has changed, I think we typically think of back in the day, a Blackstone or Apollo or someone like that they are this big private equity firm, they go to like these gigantic investors every few years. They'll raise a few tens of billions of dollars, stick it into a fund. They'll slowly invest that. And then they'll just try and get all the cash back out at the other end of that kind of like 5 to 7 year window, right?
Mhm.
But I think in the last few years, we've seen like this really huge change where it is just like individuals now who are beginning to kind of be a huge source of growth for these firms. And that's in like a few different ways, right? And it's sort of like that has evolved a little bit. I was kind of wondering if you could, well, essentially like kind of who these people are that are now this big source of growth for these firms, and kind of like how they're actually moving into all of these asset classes, because private equity and credit and whatnot used to be very mysterious and esoteric, and these days maybe a little less so.
Yeah, I mean, it's really the breadth of the wealth market. I mean, if you look at some of the recent Bain reports, there's $145 trillion owned by retail globally. It rivals the size of the institutional sort of investment dollars, which historically wasn't the case. And so it's a very large market. But I think we should all be careful to understand that like every individual is different, every investor is different in terms of what they understand, what they can tolerate in terms of illiquidity or liquidity, and what their comfort is generally. And so it's hard to paint all the retail investors or wealth investors with one brush. But what is very exciting, and I think a positive dynamic that is helping to drive the growth in this market, is that I go back 10 years ago when we were on the beginnings of 10, 12 years ago, the beginnings of this journey. And a lot of the GPs would say, well, I don't, why do I need to care about this market? Why do I need to care? It's more fickle. They're not really
Right.
with
I'm
me.
used to like some gigantic pension fund cutting like a $5 billion check or whatever. Like, why do I need to go to Joe and Jill down the street to get like a couple 100,000?
Exactly. And it was kind of, I think, a lot of sort of incorrect assumptions about the channel. And so now people have gone from sort of that perspective to understanding it's unique, it's different from the institutional marketplace, and they have to build products that actually are custom built and oriented to this channel. The first wave of those products were vehicles where we would create LPGP vehicles, if you will, feeder funds into those main funds. And those funds were really largely available to qualified purchasers, right? But as advisors are seeking to provide alternative exposures to really all their clients, then the structures have to change to accommodate accredited investors or qualified clients or sub-accredited investors. And so we're seeing a great deal of innovation at the GPs around creating structures that work to enable advisors to offer products to their breadth, to the broadest part of their
Right.
customer base.
And
And
just
that's
to
exciting.
pause and kind of think about what that means, right? So what you were saying is like it kind of started off as, say they're raising like Fund 10, like some general partner is, so like a Carlyle or someone, they're raising like whatever fund, they take out like a $10 million slice of that. And then you get that allocation, and then you're setting up a vehicle that like pulls together a bunch of retail money and then takes down that 10 million as a chunk, right? And what's happened now is like a little different, right?
Mhm. So if you will,
Mm.
the size of those vehicles have grown. We have several of the funds like you just described that are billions of dollars, right? So that type of investing has grown. But in addition to that type of investing, there are a new wave of products that are more evergreen products that don't follow the traditional fund life of, I've got a 5-year investment period and a 10-year total fund life, where they're permanent vehicles. And they have different provisions for people to redeem, et cetera. But they're meant to be permanent vehicles. And it's a different set of structures, and they're structures for equity, for credit, for real estate, et cetera. And that continues to evolve as people think about the different ways to offer products to clients. And I think it's very exciting that the GPs are investing in trying to understand, really what are the unique needs of the wealth channel broadly, and the different components of the wealth channel, to be able to create products that bring, the most aligned outcomes, for this part of the market. And we're excited, obviously, to help and to help both the GPs create those products and manage those products, but also help the advisors think about which are the products that make the most sense for their clients.
Right, because it's been moving a lot, like you said, right? So I think you said kind of at first it was really targeting that sort of qualified purchaser segment of the market, which is like
Yes.
basically there's like these different regulatory buckets of investors, right? If you're above a certain amount of assets and income, you can get access to certain opportunities. The people who are lower down on that ladder, like just by the letter of the law, they can't get access to that, and it's supposed to protect like kind of less sophisticated, let's say, investors from getting a little over their skis.
Correct.
And so, like, where are we now in terms of how much, like, if you start off on the right side, which is, only gigantic pension funds can access private equity and credit and so on, through to I can, open up an app on my phone and I have $20 in my checking account and I can put all of that into a private credit fund. Like, how far along that spectrum are we right now?
I would say we're still really early days, and I kind of think about two different metrics to sort of substantiate that. One would be the participation rate, i.e., how many advisors are actually really participating in providing alternatives to their clients, and that still is somewhat low. I'd say there's probably 70% of the advisors, 20% of the advisors are driving like 70% of the volumes. So it's still very concentrated. Small number of advisors are driving the majority of the allocations today, but that's changing and that's growing, and more advisors are getting involved. The second metric I look at is what is the actual allocation rate, right? If you look at portfolios, what percent of client portfolios are allocated to alternatives? And that's still a small number, kind of low to mid single digits. If you look at the suggestions of the CIOs, the chief investment officers at the largest wealth managers, their targets are 15 to 25%. And for the most part, people are not really close to that. So there's still a long way to go in terms of advisors participating in the business and the individual client portfolios allocating, at the levels that are suggested by their CIOs. So still early innings, I would say.
I'm so curious about that it's still such a kind of power law distribution in terms of how many folks are actually like pushing alternatives through that wealth channel. Because like you say, like what we've been typically been talking about the last few years is kind of it's sales through wealth advisors really to that kind of part of the population. And it's like, this is already huge. I know I cover kind of the corporate earnings of all the big alternative managers. And I remember kind of like the watershed moment when products like BREIT, which is Blackstone's big real estate trust, and BCRED and, kind of KKR's big things and whatnot kind of came out. It was just like hockey sticked immediately, like the kind of fees and AUM that was moving through the system. But like, it's interesting that it's still such a small slice there. And I guess it kind of makes sense as to why they're all focused on that so much right now, right?
Yeah, it's interesting. I make a couple of comments. One is, in the early days when we were talking about the sort of the feeder vehicles and the QP only vehicles, that was a point in time where, investors who wanted access had to move to the market. They had to sort of embrace the products that they were given. And what's happened, and I think this is a big change right now, is that the market has to adopt to the clients, right? And that's a big shift. So advisors, for example, they like to use model portfolios. There are ways that they create client exposures and client portfolios. And so you're seeing now a lot of work where alternatives are being put into models, either models of just alternatives or models combined, models of alternatives combined with liquid products. And the alternative industry, if you will, is now catering to and shifting to the needs of these advisors. And so I think that's a super positive trend. And I've always thought that, if the industry wants to really scale and succeed, the most important determinative of whether that happens is if clients have good experience. Do clients understand what they're buying, and do those products behave in the portfolios the way they're expected to? I mean, obviously not every investment is going to achieve the targeted returns. That's true, by the way, in all the liquid markets as well. But if people have good outcomes, they will allocate more. And all of what we've been talking about thus far has been about really customizing to this channel in a much more focused way. And I think that will lead to better outcomes. And the other piece we haven't touched on yet that I think is really critical to this is education, right? As more advisors, as we kind of shift into a bigger part of the advisor population, i.e. grow that participation rate, those advisors are almost by definition newer to alternatives, so they need education. And you can guess by extension, the clients need education as well. And so, that's a really important part of having a good outcome, because good outcomes start with understanding what to expect, from these products, not just as standalone, but in the portfolios. And so I think the educational piece continues to be an important linchpin to the continued growth in this marketplace. And you see that, I think a lot of the managers really get that and they're much more sophisticated in terms of building, universities and educational programs and so forth. It's obviously a very big part of what we spend time investing in as well.
I'm so interested in that point because I want to get to stuff about kind of like broader like portfolio allocations and what's happening in terms of like some recent changes in the wealth market and so on. But that point about kind of education, it's, I guess, a point of leverage for both the alternative managers and for kind of companies that sit there kind of enabling all of this stuff like iCapital does, right? Because like you say, it all comes down to, in a certain sense, the model portfolio, which I'm kind of guessing is like feels like doing like a target date fund like you do on your 401k app or whatever, but just kind of like souped up and more customized and more kind of like amped up with various asset classes. And I'm presuming like getting that slot, right? If I am, if I'm TPG or whoever, like I really want to be in that slot. I want to be in like whatever Lawrence is giving to kind of, the wealth advisor saying like, look, this is the vanilla, like best choice for the most people kind of model portfolio. Like I really want to be in there, right? So I presume you have a lot of these general partners kind of coming to you and essentially like lobbying to be included in those model portfolios, right?
We very much want to help them. I think, everybody, as they look at this market, understands the importance of education, as we said, and the importance of, creating the structures and ways for people to allocate. One simple way to say it is it's the easy button, right? Because it's in a model, I can adopt it to my portfolio in a more straightforward fashion.
Right.
And so it's exciting. We certainly talk to the GPs. They are very interested. And so we have a very symbiotic relationship with them in terms of really trying to create, great products for clients. I will say, and this is something we haven't talked about, but has been true about alternatives, forever. It really does matter which managers you're investing in. Like if you look at the distribution of returns in alternatives, and you look at quartiling, the top quartile manager, the returns to that quartile might be 1,000 basis points more than the fourth quartile. That's a different asset class, right? So
Yeah.
who you invest in really matters, versus a more liquid product where the sort of top quartile to bottom quartile spread might be 200 or 300 basis points. It's substantially different in alternatives. And so, the understanding that and understanding that you're getting access to top performing managers, whether they're standalone or in a model or portfolio, is quite important.
But it's also funny because I feel like the conversation almost feels weirdly flipped from when people talk about public liquid investments, right? Because if I'm saying like, oh yeah, I'm going to put some money in the stock market, like everybody understands that if I'm putting $5 in, kind of Google stock versus some extremely speculative, like just launched biotech startup, there's going to be a difference in probable outcomes between those two things, right?
Yes.
But at the same time, people, I feel, just talk about private equity or private credit as this kind of undifferentiated thing. And they just say like, oh, there are, like, to be clear, right? Like there are things like there are people for whom private equity just won't make sense because you have maybe like, difficulty getting in and out at speed, or you have to be thinking about kind of like, does the fee structure make sense for where I am right now? But you don't hear as much about like, yeah, of course you're going to get a difference if you're investing in, kind of Gold Star GP has been around for 20 years versus some guys who set up shop yesterday, right? And I guess a lot of it is about kind of making those two conversations more alike.
Yeah, but I would say the only modification to what you just said is, by the way, the new fund that just started might be started by someone who's got a 30-year track record of making great private
Right.
equity investments. And so I think the point is, you really have to look at every fund and their track record, however you can evaluate the track record, whether it's, a firm that has done fund after fund, or if it's a new manager, but a very experienced new manager. You can get great returns. The point overall is, you've got to be really thoughtful about, the managers you're investing in, because there is a big difference in terms of the ultimate outcomes.
Right. And this is going to become a more and more pressing question, right? Because, you kind of mentioned before, like people are talking about where they want to get their allocations to. And a lot of like really big players have moved into this thing. You have BlackRock
Yes.
now talking about they want to get people into alts. And that's a very different thing, even from when just it was kind of like the big kind of usual GPs. Because now we have a lot of folks in like State Street is doing partnerships, and all these other folks are doing partnerships, kind of like trying to bring alternatives mainstream. And, they're talking about like a 50-30-20 portfolio from the old 60-40. So like 20% of a portfolio is in alternatives. And I think just to kind of level set for the audience here, like these are huge numbers we're talking about, right? I think, you were kind of talking about mid hundreds of trillions of private wealth kind of floating around. Even if it were just like 100 trillion of, kind of average millionaires, you take 20% of that, there's $20 trillion going into the asset class. And for the GPs, if they're,
Yes.
pulling like a 1% management fee off of that, that's $200 billion of management fees, right? So like, I'm kind of curious as to like how close you think we get to that. Because like, I'm presuming that's a very, very slow crawl up to like a certain amount of that can be realized. This isn't like
Yeah.
a Titanic flood tomorrow.
I make a couple of points. One, nothing ever happens as fast as you think.
Right.
And I think, there's a lot of discussion about alts and retirement plans, and we are absolutely very focused on that. We're excited about that. But that's going to take years to actually really roll out in scale. And I think that, because of the sort of law of large number, like there's a massive amount of dollars in retail hands. So small percentage increases is a lot of dollars, but it takes time. And I think that's actually a good thing. I think people tend to get into trouble when they rush into things versus being really thoughtful. And so I look at the idea that people will spend time getting educated and allocate over time and take their portfolio from 2% or 3% to 3.5% to 4% to 5 or 6% to 10%. Like that playing out over years is probably a good and healthy thing. I think it should accompany the education we talked about, continued iteration around structures, and I think that will likely produce some great outcomes.
Right,
Versus
because
people rushing into things they don't yet fully understand. That could work out, or it could not work out.
Right. Well, that's the thing. It's one of these pain points in trying to figure all this stuff out, because like in the move through from kind of that schematic of how the sector has evolved thus far that we were talking about earlier, when it was feeder funds through to these more dedicated products, there were a lot of pain points in figuring out like, okay, so how do you design each of these things? How do you fit around the regulation and so on? And now we're talking about, like you mentioned, getting into retirement. So it seems like the Trump administration is really eager to throw open like kind of the 401k space in general. And for any of our listeners not in the US, that's the kind of defined contribution pension system that's totally standard across like large US employers. And I kind of wondered like where that puts you guys, right? Because you have obviously created like a really, really strong position sitting in this kind of like wealth advisor space, which is where all of the volume has been thus far. I'm presuming like the pension stuff is going to be slow to roll out. There's a lot of like literally just like legal liability issues that need to be figured out. But like, how do you think about like where the world is going there? Because just intuitively, you would think this is like, 10xing or whatever the potential size of the market, right?
I think it's a lot. I think, it's funny because there's a lot of people who are obviously talking about this, but we see this, if you look at, the defined benefit plans, they've been investing in alternatives for forever, right? I mean, you look at the biggest foundations and endowments and pensions they've had 50, 60% allocations to alternatives, right? And so it's very reasonable, given the long dated nature of retirement assets, that there be a healthy allocation. But it's not going to be, and nor should it be, individuals deciding what is going to be, I got to pick. In some cases, it can be because they're sophisticated individuals, but in other cases, there'll be professional managers who are, on behalf of the beneficiaries, helping to create portfolios, and those should be people who are deeply educated in the asset class and have obviously tremendous investment experience. That's how we see it playing out. And we see, there'll be different structures that people use. Education will continue to be important because, by the way, the retirees need to understand what's going into their retirement accounts. And so the educational obligation is still quite strong. We think professional management will help. Professional advisors will help. And so, but that's why I say it'll play out over time. And there'll be an infrastructure around that to help, raise the probability of successful outcomes, for the individual retirees. And that, that will play out. But I do think the one other point we should touch on is this sort of idea of risk. Because I think that's wrapped up in all of this stuff. And I do think that, there's risk in every investment. You look at the liquid markets. The liquid markets have some very interesting dynamics right now. There's a very small number of stocks that really drive market returns, right? By the way,
7 specifically, I believe, right?
Yeah. By the way, the universe of investable public companies is actually, relatively speaking, quite small. Maybe 4,500, 5,000 companies. So it's not like it's a massive universe. There are hundreds of thousands of private companies that are investable. And so from an investment landscape perspective, the private markets offer, a much wider choice of investors and of investment choices. But the public markets today are very concentrated. So there's a lot of risk in all investing. The private side, has some different types of risks, liquidity being one of them. You need to be able to understand the relative illiquidity of private market investing. But in some cases, it has less risk. In other cases, it has more risk. But to say that private investing ipso facto is riskier may not be the right way to describe it. It has a different set of risks that people need to understand. But public market investing is also quite risky.
Well, I mean, we've already been through a test point, right? Because I'm curious as to whether this was a learning experience for you guys. We had a watershed moment, which was after that first big influx of volume through these, the kind of, I guess, what you would call the current generation of wealth products, right? We had a cycle where interest rates went up a lot during 2022. And kind of leading into that, we had a series of wealth products from a few managers, maybe like a half dozen, kind of hit their redemption limits. So, you're allowed to withdraw X amount per month and per quarter, and some of those hit the limit. And then that was kind of like a slow bleed off as that kind of came back down. And I'm just kind of wondering, like, I think for a lot of people, the easy thing was to say, like, aha, look, we said that there would be problems with these structures. And I think, I think my perspective would be that it falls on a spectrum, as with all these things, where some of them were tested in a way that maybe made them look a little bit like, okay, maybe that didn't pass the test, and others looked like they were kind of managing through that. But for you guys, I'm imagining this kind of probably felt a little more existential, right? Because this was a first big test of like, how does the confidence in the whole kind of wealth alt story hold through that first kind of difficult cycle?
Yeah, well, obviously since then, alts investing has grown, right? So it's not been sort of you talk about existential moment. We have worked through that, but to me, that's an example of what I just said around risk, right? That all is part of what I think of as liquidity risk, and I think people have to understand this. Structures notwithstanding, okay, these are still illiquid investments. And real estate is obviously among the less liquid investments, right? They're
Mhm.
about big properties, et cetera. And so while the structures, I think in many respects are thoughtful and clever, they are still illiquid. The amount of liquidity you can get in any quarter is typically around 5%. And as we saw, there are some quarters when people want more liquidity than that. And so to me, that's a part of the education and how these products are sold that is so important. And it's why sometimes I get a little worried when people describe these assets as being semi-liquid, because
Right.
in a human to human dynamic, what I say and what I mean may not be what you hear, right? And think. So if I
Right.
say to you, these are semi-liquid products, I might mean, hey, they're only semi-liquid, they're not really liquid. And
Mhm.
on the other hand, you might be hearing, oh, they're liquid. And so I think the evergreen nature of these products doesn't change the fact that the underlying investments are still largely illiquid. And so when people buy these products, they should still buy them with the mindset that they are liquid investments that are long term in nature. And while there's some liquidity features, there's some opportunity for me to get some liquidity. I should still think about that investment as an illiquid investment. And I think that's a really important part of the education. And I talk about risk. The liquidity risk, continues to be the big one for people just to understand and make sure they have their arms around.
Right. I mean, just to wrap this all together, so we kind of like you're saying, we're heading into what is potentially quite a big moment, probably a slowly moving moment, but a big moment nonetheless. There is a role for like the kind of established ecosystem to play, kind of offering through kind of that advisory and educational channel into the kind of emerging, mass retirement space. Obviously, iCapital, you guys just did a fundraise recently. You're handling billions in assets at this point on the back end. We're seeing really, really huge kind of estimates of the total addressable market here. We've talked through some of them, right? But at the same time, you have a lot of folks kind of saying, like, oh, we've got the rise of AI. We've got, maybe everybody's just going to ask ChatGPT to figure out their portfolio and then they'll be left to run with it or what have you. So, like, kind of, I guess, putting together where we are on everything here, just to round this out, like, how do you see the next few years for you guys and then for the broader kind of market going?
Sure. I just have to say one more thing on the sort of the REIT thing we talked
Hmm.
about a second ago, if
Hmm.
you'll excuse me.
Yeah, please do.
And that is, the way those products behaved, and I think people need to understand that the way they were quote gated
Hmm.
is a feature of those products. It wasn't a bug of those products, right?
Right.
The fact that that the liquidity is limited is a feature to protect the underlying investments from having to be fire sold, if you will.
Hmm.
So I think those products worked as they were supposed to work. And again, I think that's something that people just need to understand. In terms of the where we're going, technology, it reminds me. I've been asked about AI taking the role of advisor and so forth, and it reminds me a little bit of the discussion 5-10 years ago when people were saying, "Will robo advisors replace human advisors?" And I think the answer now is similar to the answer then, which is no, they won't. They have different roles. And human advisors play a really important role in making sure people are educated and really taking the temperature of do people really understand risk? Do they understand liquidity? Do they understand all the different components? Do they understand what the client really wants, what the client really needs, et cetera, both in the near term and the long term? And I think the role of a human advisor is essential in this process. Having said that, the best human advisors are going to use the best technology they can get their hands on to help educate their clients, to help create the best experience, to leverage the decision-making opportunities that things like AI and technology provide. So I think the future state is likely to be one where there are, client advisors who really take the time to understand exactly what their clients need and how they feel about different aspects of investing, and they're going to have a great portfolio of technology to help serve their clients most effectively.
Got it. Okay. And of course, that's still going to be like you say, you guys are going to be doing a bunch of the education there. There's going to be some very, very hot, kind of like, let's say, room on the shelf for folks to be investing in coming up, and like making sure that they're going into the right place. Like that's a lot of money
totally.
rides on that, right?
We want to help provide those advisors with that technology, and the product access to best serve their clients. So we use AI in several respects across our business today. And we expect to continue to roll out AI initiatives across the various functions within iCapital, both the internal functions on the operational side, as well as client-facing functions. And today we have, close to 2,000 people, and almost 700 of them are engineers, technology engineers and product people, making investments in technology that we think help create a better experience for advisors and clients.
Got it. Okay. Makes a ton of sense. Well, this has been great. Thanks so much for your time, Lawrence. Really appreciate you joining us.
Absolutely. A pleasure to be here. And thanks for including me.
That's our show this week. Thanks to Lawrence and Jonathan for that really interesting and in-depth discussion. And as always to you, thanks very much for listening. This podcast was produced by Oliver Tasich in London and Pranav Kiran in Toronto. You can listen to a new episode of The Big View every Tuesday, and don't forget to tune in to our sister podcast, Viewsroom, every Thursday, as well as other great podcasts from the Reuters team. Please let us know what you thought. For more in-depth conversations, follow The Big View and check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.